Welcome to the latest Motley Fool Scoreboard. I'm on in Sciple, and we've got longtime fools Nick Sciple and Tyler Crowe giving a 1 to 10 rating to options and futures exchanges owner CME Group, ticker symbol CME. Talk about the business first, including factors like industry and competition. A 10 is invincible, a 1 is hopeless, 2 9s here, Nick.
Yeah, CME Group, one of the leading futures and options exchanges in the world. If you need to hedge interest rates, your energy costs, your currency risk, and your agricultural products, you're growing soybeans and need to lock in your cost or your what you're going to make for the year, CME Group can do all that for you. Being an options and futures exchange, pretty attractive business. One of the only businesses you'll ever find with 100% gross margins. Also, this is a true network effect business. The more people that are participating in these exchange markets, the more valuable it is to the other participants as you add liquidity and that sort of thing to the market. The only thing knocking it down from a 10 for me is that this is a business that is super highly regulated, and that does take a little bit off.
Yeah, I mean, where else are we going to trade pork belly futures if we don't have the CME Group, right? So, I mean, technically speaking, there isn't anyone stopping a competitor from creating a competing futures market. But the whole point of futures markets is that, good luck getting other traders to use it, because that's kind of the fortuitous flywheel that is involved with exchanges. Like Nick was applying interest rates, energy, currency, metals and minerals, as well as like index products and things like that are on the futures there. We're even starting to talk about crypto too, because there whispers about crypto futures contracts. The more people use it, the more markets it can create and more liquidity that is available, giving it this flywheel effect to grow transaction fees. I mean, one could argue that a bear market would hurt it because, it tends to move with total transaction volumes on those transaction fees. But so much of its business is in other assets than like equities that I don't know how much it would hurt that company that much.
Let's move on to management. A 10 is a Warren Buffett. A 1 is Homer Simpson. 8's all around here, Nick.
Yeah, Terrence Duffy has served as chairman of the board since the company came public, has held the CEO position since 2016. During his time with the company as chairman, presided over a 14x increase in diluted earnings per share and almost a 29 times increase in stock price. That's not bad for a day's work.
Yeah, I gave it an 8 as well. I really appreciate management's kind of stick to their knitting approach to this capital markets space, kind of in contrast to what's been going on in the capital markets and the capital markets data company space over the past 5 years. There's been a slew of industry consolidation and almost like asset horse trading that has been going on, sometimes at very, very high valuations. And many of those M&E deals, I'm not sure how many of them have been proven to be successful yet. And so a company that is like, look, we know what we do well, and we're going to return shareholder value based on what we do well. I really appreciate a management team that is willing to stick to their guns on those things like that.
Financials time. A 10 is a fortress. A 1 is yikes. Nick's at an 8. Tyler, you're at a 9.
Yeah. I think some people will get scared of CME's financials because they are really unique, like, $100 billion in current assets and current liabilities. But, if those are kind of related to like short-term things of like at any given moment, you have to have these things on your books to facilitate trading. It's not like these are actual debt that it's taken out. If you look at the corporate business, it has more cash than corporate debt on the business, and it generated $3.4 billion in cash from operations in a business that practically takes no assets to build or maintain. I think it had like $34 million or maybe $70 million in capital expenditures in the entire year. So like it cash generative and a clean balance sheet is something to love.
Yeah, I agree with Tyler. If you look at the balance sheet optically and aren't familiar with the business, the short-term debt could look scary. But if you understand what an exchange business is and why that's there, this is a balance sheet that is robust, and the business is really a cash machine. Year in and year out, they're going to turn, call it 50% of their revenue into free cash flow, maybe a little bit less than that. And it's hard for the business to really get disrupted by what's going on in the market, just as a cash machine business.
So for all the fundamentals, it's been all 8s and 9s. Maybe buying my first stock off of this in a while. We'll see. We'll see how the valuation goes. Nick, how well will CME Group's stock do over the next 5 years? And how safe is it? A 10 is a sure thing. A 1 is a lottery ticket.
Yeah, so I went 5 to 10% returns and a 9 safety score or for CME Group. For the returns, you've got about a 4% dividend currently. That's if you assume the variable dividend that they pay out remains the same, and I think they can grow at least at GDP. If you think there's going to be more volatility or they take share in the category, you could get to higher returns. But for that 5 to 10% return, I think it's about as safe as you can get. The predecessor business began in 1898. It's got a network effect, as I talked about earlier, that it's really going to make it difficult for other folks to disrupt the business. I don't think it's going anywhere. It's a cash machine that's going to keep running for a long time to come.
So I did returns of 10 to 15% with a safety score of 7. So a little bit higher return, slightly less safe. And I'm going to make the case for better returns because market makers love volatility. That's what they feast on. And, the past 15 years, we had a pretty idle time in terms of interest rates. So there wasn't a lot of hedging interest rate risk at, low to no inflation, low to no interest rates. So rising interest rates means more hedging contracts for interest rates. Volatile commodity prices means more hedging. Unpredictable political changes means more foreign currency hedging and tariffs and everything like that. You're trying to, manage these risks. And, general volatility means everyone and their mother becomes an energy futures trader as well. So just throw that in, add crypto on there as a little extra jet fuel on the fire. More volatility also means that people start taking more extreme positions on the futures curve, which gets higher transaction fees because it tends to be a higher risk hedging contract. All of those things would seem to indicate that, the volatility over the past 15 years is maybe not indicative of what we could see over the next 5.
That's a strong bull case, Tyler. Let's move on to top it. Nick, is there a company in CME Group space you like more?
Yeah, I like CME Group a lot. If I had to pick another company, Intercontinental Exchange would be the one. Ticker's ICE. It's the parent company of the New York Stock Exchange. Has been a better performer than CME over the last 5 years. Although if you zoom out to 10 years, basically have been performed exactly the same on a total return basis. Intercontinental Exchange has been much more acquisitive and has been much more aggressive with share purchases throughout its history, whereas CME has focused on its variable dividend policy, really just returning cash to shareholders. So if you're less concerned about income and are interested in maybe more upside over the long term, Intercontinental Exchange might be a better option for your portfolio.
Yeah, I don't know if it's a top, but I'll just give an alternative and I'll say MSCI. Although not a marketplace, it's a business that basically is in the business of building indexes and indices for ETFs and hedge funds to benchmark their performance and things like that. Risk management assets. It's a fascinating business, and it's about almost as durable as market makers themselves. They build products that people pay a subscription for, and as long as they have assets under management, that subscription fee is going to be a percentage of that. Not quite assets under management, but pretty close. Renewal rates on those are incredible. It's a very, very durable business that in a world of passive investing, MSCI is one of the kings.
Yeah, when Tyler and Dan Kaplinger did MSCI, gave them a 7.7, which is a little lower than what we got here. Thanks to both Nick and Tyler, they've given CME Group a strong overall score of 8.0 out of 10. It's actually 7.95, but hey, one decimal place, that's 8.0. That means I'm buying a new stock. Welcome, CME Group, to the On and Chocovaloo portfolio. Look out for a new scoreboard every market day at 7 p.m. Eastern. I don't know what's up next, but I'm sure it'll be good. Till then, Fool on. So the Chicago
Mercantile Exchange. It's where we trade all our hog futures.